Unlock your potential with a comprehensive suite of investing tools and expert education with GammaEdge. Start your free 14-day trial today.
Cumulative, like out of the money put or call, tends to be an area that it bounces or it gets close to it, and it seems. And I think what my understanding is if it exceeds that level, then the dealer is taking on more risk that they have to manage. Is that the right way to think about it?
Michael, Paul, y'all can step in here. I don't, admittedly.
It's where the charm flows flip. That's a summation of it.
It is. I think Panther is, that's a good description. I think another way to also think about it, it's not so much on the dealer side, Jim. I think the COTMP value, which is where the cumulative out of the money puts transition to more in the money. Okay. And so what does that mean? So we've proven elsewhere that the majority of transactions that occur are out of the money options. They're not in the money option. And so you as a trader, you want to buy that convexity, which is why you buy something that's a 20 delta, 30 delta, 40 delta, maybe even a 50 delta. And as price moves in your direction, you are prone to take your profits. So the COTMP and the other one is the COTMC.
That makes sense to me. Yeah.
Yeah, they're opposites of each other. And so what happens is so traders have played to the downside. They've bought out of the money puts, and now as price falls, the moneyness of those puts starts to transition from out of the money to in the money. So when you see on your screen COTMP, that is the level that we would expect, all things being equal. It doesn't always work out this way, but this is where the balance point for traders starts to shift from their speculation to greed. This is where we see price now starting to support the thesis, I'm going to take my profits, watch for a bounce in that area. And actually, I'm going to share my screen right now because this was a great question, and I want to highlight something that will exemplify this happening today. So we're getting ready to release this to beta testers within the web app. We have TradingView incorporated, and we have automated updates of our levels. And down here in this lower quad, I've got Microsoft, and you may not be able to see it because it's small, but this label right here is COTMP, and you can see it got violated at the open. The range that it gets violated to the downside is usually no more than a little more than 1%. So you would have an expectation that if you go through COTMP, that you could continue down for another 1% or more. But you can see where that level mysteriously became a point of reflection. And so to the observation, if we start seeing price in a liquid instrument start moving towards COTMP, we would expect that would be a good risk a reward location for going long, for expecting a reversal of that downward trend. Now you can see with Microsoft, it didn't necessarily adhere to it early in the morning, and there's lots of reasons. I mean, market action is market action, right? More people, getting on the bus and heading down. But in general, this is one thing that we would be looking for, and we see this behavior where it reflects off of COTMP quite a bit. So I would urge you, for the liquid stocks and ETFs that you're trading, I would urge you just to pay attention to that setup. And I think that goes directly towards how Taylor was, answering the question.